Good morning. I'm Maurice Crespi, Managing Partner of Schindler's Attorneys. Schindler's Attorneys is a co-founder of COBRA. We've just rebranded COBRA. This is our new brand. We're focusing on shared value and gifted value. The idea behind gifted value is that if you're a business in distress, we have over 75 partners who are there to assist, even on a gifted value basis, just to resuscitate you, get you back on track in these tough times. As I said, we have over 75 partners. We have the founding partners, IQ Business, Schindler's Attorneys, and Engage Turnaround. But a few of some of our other partners, we have Agility, who are business consultants who are there to help. We have Nallycat, they are involved in AI. We have Aon Insurance, we have Elysian, who are in tech, Fleet Elite, who are asset disposal, an asset disposal company. So the idea is we have a range of partners, and those are just a few of the partners. And as part of our offering, we provide mediation services. We consult with you and your team. We can meet with your team, in fact, or your employees, and discuss variations to the employment terms to the extent needed. So please reach out. You can do so on www.cobra.org.za. Today, we have Transunion. Once again, we're indebted to them for their invaluable insights. Today, we're dealing with SMMEs, and we're joined by Zachar and Priven Moodley. A bit about them. Hans is the Vice President of Emerging Markets at Transunion with strong tech background. Hans is focused on analytics and has led transformation. Hans started his career as an electrical engineer focusing on IoT developments, and then shifted towards tech consulting and tech-led transformations. Hans has been awarded both a bachelor's and master's degree in electrical engineering from the University of Witwatersrand. Priven Moodley. Priven heads TransUnion's Africa Consulting Division. He's responsible for driving business development within direct marketing, customer acquisitions, existing customer and collection strategies, business intelligence, fraud prevention, and regulatory compliance. He's been an active member of the financial services industry for over 8 years, gaining experience across consumer credit, commercial trade credit, and public sector industries. So thank you very much, guys. Before I move over to you, I'd like to introduce the remaining panelists. We have Emma Marseille, who's from IQ Business. We have Adam Kraker, who's the CEO of COBRA and the Chief Executive of IQ Business. We have Zizile, and she's from IQ Business. So thanks so much, guys. Thanks for everybody for joining. Thanks to the Facebook audience for joining today. It's good to have you back. Thanks, guys. Over to you.
Good morning, and thanks, Maurice, for the introduction. And thank you to COBRA for the good work you're doing in the market and the opportunity to present today. I'll be working with Priven to present. If we can just have the slides up and sharing straight to the agenda slide. So, I mean, as Transunion, we've been doing a lot of work in the in understanding the economic impacts of COVID. And we've particularly focused our attention on the SMME community, as well as the hardship amongst the consumer community. So as we, the way we do this is that we look at both the data as well as sentiment, looking at the, see, we have some technical challenges. I'm just going to try to share my screen instead. Okay, there we go. So in today's session, we really wanted to focus on 4 things. So as I said, we spend a lot of time looking at the data and understanding what it tells us about how consumers and commercial entities are interacting in the environment. We also look at the sentiment. So we send out quite a few surveys just to understand how business owners and consumers are doing. So today, what we wanted to do was spend a bit of time and recapping what we are seeing from an overall market sentiment. So what are the surveys telling us? What are people indicating in terms of their level of distress? Secondly, to look at the data, and we want to look at the SMME market performance and the projections. So during the COVID period, we've been looking at the overall default rates, and are those changing? Are those getting better? And are they moving along a certain path and a trajectory that we expect? Now, off the back of that data, we can also start looking at what is the actual business risk. And in today's presentation, we actually want to spend a bit of time to start looking at what are the job loss projections, and are there particular segments in the market where we're seeing more risk of job losses? Are we seeing potential areas where there's actual job growths? And what's the overall view from a business risk linking to that employment world? And then to kind of look at that, just a kind of a preface, the numbers don't actually look too encouraging. So I think the fourth element of the presentation today is really to start looking at, well, do we actually see pockets of economic opportunity or pockets of risk? So if you're operating in a particular segment or a particular sector, how is the overall risk in that industry? Are there particular pockets where it's more risky? And obviously, are there pockets where there's an increased opportunity where we can start looking at growth and other prospects? So just as a way of introduction, I'll be taking us through most of the overall sentiment, as well as the overall economic performance and the SMME performance. And then Priven will deep dive into the industry segments to start looking at, can we see pockets? Can we see how each individual segment is performing? So just before we go into the detail, as Transunion, we've been consistently tracking just the developments in the market, and we've been tracking against 3 scenarios. So the rocky scenario is the underdog story, the one where South Africa gets into a tough spot but is able to bounce back. Lemonade talks about the middle road, so making lemonade out of lemons, where we're somewhere between not quite the best but also not quite the worst. And then I Am Legend refers to the Will Smith movie, where we're talking about the worst case scenario where we think get really tough. And as we've been tracking this, we've been tracking certain economic figures. So things like GDP, unemployment, repo rate, CPI, and disposable income. And largely, as we've tracked, as COVID started, we thought we were in lemonade, but the reality is that we are starting to trend towards the I Am Legend scenario. So as you see the GDP figures coming through, the unemployment rate figures coming through, where we're starting to pivot between lemonade and I Am Legend, even as we come into stage 1 and decreased regulations in the market. So firstly, just to talk about where are we in those scenarios, I just did want to recap, and for those of you on the previous webinar, some of this material may be familiar to you, but just to give you a sense of how are SMMEs feeling in the market and what's the overall markets, the sentiments among small business owners. But the first thing is, let's actually talk about what actually is a small business. So if you think of corporate South Africa, you've got about 8,800 large or public organizations. So those are the household names that everyone will know. So the ShopRites, the big banks, those are really the big companies that everyone will know. Then we have about 38,000 medium-sized organizations, which falls into that sort of middle tier. But if we start thinking about small and medium enterprises, we really start thinking about the 340,000 small businesses, and that's classified as businesses with less than 100 people. These are the 340 registered businesses. So they're formal businesses, they have a registration number, they pay tax, and they're conducting business in the market in a formal way. But then a large part of our market, in fact, anywhere between 1.7 and 2.5 million businesses are actually in our informal and sole prop category. So these are typically a couple of people trading in their personal capacities. So think of your spaza shop owners, perhaps small manufacturers, people really operating under or outside of the formal construct that we would normally take of a business. Now, if we look at those top two segments, and just to give a sense of what they actually contribute to our overall economy, these businesses represent about 40% of corporate turnover. So it's not an insignificant amount. They are estimated to provide anywhere from 40 to 60% of our GDP and employ or provide income to approximately 10 million people in the country. Now, this is an incredibly important segment when you start thinking of entrepreneurs and economic growth. To a large extent, the government and various groups see this segment as our best engine for growth moving into the future. And in fact, if you look at the National Development Plan, where that segment alone is expected to add 11 million jobs and contribute significantly 60 to 80% of our future growth in the economy. So a very important segment to watch. So how is this segment doing? So these are the survey results from June. We sent this survey out to about 100,000 SMMEs, got a statistical response sample. And what we saw a few months ago was that 9 out of 10 of these SMEs were struggling or temporarily closed. So a very difficult position. And if you look at the right-hand side, the vast majority of them didn't believe or at least had some uncertainty about whether they would actually survive the COVID pandemic, with a large proportion of them believing that they wouldn't last longer than 6 months, and another sort of 20-odd% just uncertain of the overall future. So it really painted a lack of confidence in these SMMEs. When asked in terms of how concerned are they about meeting their obligations, their payment obligations, 50%, 25%, a total of 75% were extremely or very concerned about meeting their payment obligations. And you see on the right-hand side that these were businesses that were cutting staff, letting people go either permanently or temporarily, making arrangements on their lease in that they were unable to pay that, taking owner salary cuts themselves. And then you start seeing more worryingly that these businesses were starting to cut essential services or even the operational expenses which drove their business. So if you think about equipment that they used to manufacture, loans on those equipments, rent on those equipment, supply and inventory, the products that they sell, and the people that help them to take to the market, these were businesses that were cutting those things during the COVID period. So to the extent that they were largely unable to operate. So if you looked at the impact on consumers, we also do a regular consumer survey. And what you can see is that unfortunately, from a consumer perspective, it's been the poorer households, the under 100,000 under 100,000 Rand as a household income group that was largely affected. We saw consumers in the construction, the food services industry, and manufacturing being one of the hardest hits. Now there are lots of industries which felt the impact. These are the top 3. We'll spend a bit more time in the presentation looking at a deep dive. But then on the right-hand side, in terms of the consumers that bore the biggest brunt, felt the most pain, you can see that 60% of consumers experiencing hardship actually work for the SMMEs that we're talking about today. So small businesses seem to, in terms of the impact on the individuals, they were the ones that saw the biggest impact, and then the consumers saw that in return. So if you look at that and you look at that sentiment, and we must remember sentiment is sentiment, it's how people are feeling. And we pivot over to say, well, what exactly is the data telling us about the performance of these businesses in the market? So they may feel a certain way, things may be tough, but how is it really happening, and what are we seeing from an overall risk, credit, and default perspective? Now, maybe just to spend a quick minute to understand how the default on credit is a predictor of future business performance. So if you look at the left-hand side, a simple profitable business, debtors or customers who provide revenue into the business. So those are the people that we sell product to, we provide services to, who essentially generate the cash that the business needs to operate. Working capital talks to operational expenses. So the salaries, the rental, the equipment, all those kind of things that consist, is just the normal running expenses of the business. And then finally, if we look at creditors as the input to the business, which funds a lot of the growth, funds the loans on equipment, on cars, on vehicles to make the business work. Now, what we've seen is a lot of businesses coming under strain. So if you look at the right-hand side in terms of a business in distress, the first thing that obviously happens is there's less customers, there's less trade. So from a debtor's perspective, we have reduced revenue. Now, as you can see from the sentiment on the right-hand side, small businesses have really cut into that working capital bucket. So they've cut the staff, they've cut expenses, the rent, and those kind of things. And then you start seeing that there's a disparity between income and expenses. And when a business starts getting to that level of distress, you start seeing that the actual payment to the creditors or the loans that support that business is where we start seeing payments coming in late or outright defaults on that particular bucket. So when we start looking at credit, it's a good predictor of how the business is performing, to what extent the income is matching the expenses, in that when we start seeing that a small business defaults on credit, to a large extent, that can tell us from a behavioral perspective that we may be seeing the beginning of the end for that business. And we start seeing that those businesses track that glide path, that the credit becomes increasingly, the credit payments become increasingly pressured, and then ultimately the business fails and defaults. Now, when we track SMME credit, what we do is we not only look at how the business is performing, so how are they meeting their credit obligations, but it's also very important, and particularly in the informal businesses, in that there is no registered entity, you have to understand how the principal is conducting themselves in the market. So we also track how the owner of the business, the face of the business, is meeting their payment obligations. And typically you see there's a very strong correlation between obviously the business owner and the business and how they're performing. Now, what we do is we take all those data points and we wrap it up into an overall risk or a probability of default. So when we look at the various segments, and we've simplified it here to just look at the sort of high, medium, and low risk, what you can see, and this graph really tells us, well, has there been a meaningful change in credit risk across the various segments? So if you look at public sector organizations, largely the risk there has remained static. So public sector is a fairly low risk environment. For those of you working with public sector, you might argue that they don't pay their bills on time, but largely public sector pays what they owe. And it's a very low risk environment to operate. During this time, large corporates, the big businesses, have actually fared fairly well. So there's been a marginal risk increase in that segment. So you would see some high profile, perhaps defaults coming through, but largely that segment is pretty robust and weathering the storm quite well. But if you start looking at medium and small enterprises, there you start seeing a material change in the default risk and the probability of default. So you can look at these sort of the orange and the red moving from Q1 to Q2. We have seen, the low risk businesses in the medium space go from 66% to 57%, and in the small from 65 to 53, which is a significant change, which you don't often see in the market. So how does that all stack up? if we start looking at what the impact of that is. So when you look at sentiment, and we drew these curves based on sentiment, right? So how are people feeling? And if you look at the small to medium business and you look at the default rate, so in June of 2019, we saw that the average default rate, call it the SMME, defaulting on their credit or ultimately failing, was roughly around the 4% mark, and we were looking at about a 29% unemployment in the June period of last year. Now, if we look at June this year, that actually marginally increased to about 4.5%. So think of that as 4.5% of businesses defaulting and ultimately failing over the next 12-month period. So it's a predictive measure to say, in the next 12 months, 4.5% of businesses will get into that default and failure category. And then we saw, again, a marginal official unemployment figure of 30%. Now, you might think that that's quite low, but you have to remember during that time, that was when the fire hoses of funding was coming out, right? So there was a lot of money being pushed into the environment from a UIF perspective. The banks were distributing the private funds of the various organizations that gave them. And there were lots of payment terms and payment holidays that were being granted at that period. In fact, from the survey results, we saw that almost 75% of businesses were enjoying some form of relief around about the June period. So largely while they weren't able to operate and they were cutting staff and cutting expenses, they were largely looking okay in terms of being able to survive this. Now, if we fast forward the few months to August 2020, and this is the data as at the end of August, you can see that that default rate climbed over 50% to 6.4% default. So in our curves, based on our sentiment, where we look at the green curve, the sort of best case, the orange curve being the middle case, and the red curve being the worst case, we were at that point, at the end of August, roughly tracking between the sort of 5 and 10% default rate at that point. Now, if you look at what does that actually mean, if you look at the unemployment rates at that point, 33%, which is the recent numbers coming out, which translates to, in this segment, around 260,000 jobs actually lost. But based on the default rate, you can expect another 240,000 to be at risk. So within the next 12-month period, given the inherent weakness in those businesses, essentially 240,000 people will lose their jobs by this time next year. Now, the other worrying element is that during, after the August period, all those payment holidays and those mechanisms are largely coming to an end. So while we still do have UIF, we also have the bank guaranteed scheme coming through, although uptake is quite low. There's sort of traditional mechanisms that businesses are giving each other in terms of payment holidays, extended credit terms, or even the loans that these businesses have, their vehicle loans, their property loans, both in their business and their personal capacity. The obligations to pay those loans are coming due. The suppliers are going to start looking for their money. So we're expecting that the curve to uptick over the next couple of months to the end of the year, where we start looking at default rates of anything from 10% on the best case, 20% on the medium case, and 30% on the worst case. Now, the important thing to understand is how does that actually relate to jobs? So, we'll go through the high-level numbers, and then Priven will take us through the individual detail. But if we end up on the 10% default curve, that would mean that there's another 700, or a total of 700,000 jobs at risk over the next 12 months. And that would mean that we reach an unemployment rate of 36%. Now, to be clear, this is the contribution in the SMME segment only. This does not look at the knock-on effects in our corporate world and other sectors, where these SMMEs operate. So in that ecosystem, a large part of our economy does business with these SMMEs. They service customers as well as suppliers to a large part of the formal segment. So if we look at it just in isolation, we look at the contribution in the default rate in SMMEs, we also need to recognize that there may be knock-on effects in the corporate segment. So if you start looking at the 20% default rate, the numbers there climb quite staggeringly to 1.6 million jobs at risk and a 41% unemployment. And then obviously the worst case scenario starts scaling from there. But based on the current projections and our current path, you can see that we're tracking somewhere between 10 and 20%. In fact, if things remain the way they are, we would actually track at a 14%, which means that we land somewhere between those two scenarios. So while we've only lost 260,000 jobs, to summarize, there are significantly more at risk. And if these default rates continue to climb, that number obviously scales quite dramatically as we go into next year. So at this point, Priven, I just want to check that you've solved your technical problems. We'll hand over to Paul, and he'll take us through just a deep dive in terms of where do we get these numbers from, how are they calculated, and how is this distributed across various industries in terms of understanding the relative impact in each industry segment. Priven.
Thanks, Hans. If you don't mind, I can ask you to drive. So Hans took you through kind of the impact that we're seeing across the market from the beginning of the year into the Q2 stats that we have. And I think we can agree there's quite a material impact that's coming through on the SME market. So what we decided to do was to have a look at where and what stress points the market is actually carrying across. So what you see here is essentially a distribution of the SME market broken down by the different industries and sectors that operate within the South African context. And you can see clearly the jumps materializing that we saw on the slide that Hans presented to you guys earlier, of where the SME market is driving primarily towards a high risk and a medium risk contribution sector of roughly around 50% of the market being at risk of closure, default, or failure in the next 12 months. Now, of concern is the sectors that these are materializing through. So what we see is within the construction, retail, trade, and transport and communications, that's where the majority of the jump has come through. So naturally, understanding the dynamics of lockdown levels that we've gone through and the restriction of trade and movement, transport, retail services, and construction naturally would have taken the hit. But to that context, the concentration of businesses that are sitting in the medium and high risk sectors within this population has increased quite drastically per the numbers that we can see coming across. So transport and communications, as an example, has gone up to 46% of the population of businesses within the SME market, and is moving to almost 1 in 2 businesses having a probability of default or failure within the next 12 months. And this is not going to your conventional wisdom of businesses within the first 12 months or the first 24 months that emanate out of the SME population. These are established SMEs that have been trading for years that have come across. Now, the important point that comes with this is the concentration of jobs and how consumers are generally employed within these industries, and the knock-on effect that it potentially has in terms of personal and consumer consumption that may lead to even further stress on the total GDP count that South Africa has. So what we decided to have a look at, and Hans, if you don't mind clicking over onto the next slide, is the trajectory path that we've had coming into South Africa from an unemployment perspective. So we've had a fairly robust growth in terms of the workforce population. And by workforce population, we're essentially looking at consumers or individuals that reside within the 15 to 64 age group of South Africa. And you can see that steadily grow. We had the number coming out of the Stats SA QLFS survey coming roughly around 38 million consumers or individuals that reside within that population. The employed population, in contrast, though, represented by the orange line here, hasn't drastically moved over the past 5 years. We're still roughly around the 16 million employment mark, And that primarily shows us a stagnation or a difference being drawn out between the number of people available in the country for employment against those that are actually successful in finding jobs or even keeping them to that extent. Our labor force, essentially those looking actively or within the discouraged stages, you can see climb up to 23 million towards Q1 of 2020. And then we decided to take a step out and we're saying, well, if we're seeing stagnation in the employment, where is the unemployment actually moving towards? And that's the blob that you see on the right-hand side. So you can clearly see that within the unemployed population, consumers or individuals actively seeking jobs have increased drastically, much more to the extent of where the labor force and the employment stats are actually allowing them to do. Now, this is an important pivot point because we're seeing and potentially finding a lot of stress coming out of the SME market. You can see the increase of business risk and risk of failure that's potentially carrying across of the different sectors to the point where 1 in 2 have the probability of failing in the next year. Now, while that's important, the original stat that Hans presented to you guys up front, it is an industry that employs or segment of the market within small and medium enterprises that employs 10 million consumers within the South African market, which you can see is almost 2/3 of the population that sits within the total employed pool, which is where the concern potentially comes along. So what we decided to do was to combine both stats that's available from an industry perspective and also the business risk that we foresee within the Transunion universe of monitoring. And taking this lens of view, we have the breakdown. The total numbers here on top of each of these stack graphs are essentially the current employed population that resides within these businesses. Now, essentially extrapolating the risk of failure that we see across each one of the industries, and naturally the excessive risk coming through in transport and services, retail, and specifically within construction, and the marginal coming through in finance, you can see the varying differences of impact that this may result in. So again, in populations, thousands, the big impact in terms of if we had to go down the route of severe stress or the 30% default scenarios that Hans presented to you in the flight path over the next 12 months, there will be a significant impact in terms of job losses that these industries undertake, and specifically within transport services, retail, and finance being one of the largest contributors to employment within the country. So just to kind of encapsulate this into a total impact across each of those industries, on a reduced stress or a best case scenario, we still will be on a path of losing 510,000 jobs across the various industries. The current path will add an additional 170,000 jobs into the unemployment spectrum. But the concern is unchanged or unchecked, or with minimal interventions put in place to kind of save the SME market and the stress that we're coming across to. Minor increases in the stress pool or minor increases in the risk that businesses are facing from trade stimulation and economic growth. That stress part that takes us onto our 20% default path or the projection that we see will put across an additional 820,000 jobs at risk across each one of these industries and sectors. Naturally, the worst case scenario, and the hope is that as the South African economy and community, a lot will be done to prevent this, will take us to a potential of almost 3 million jobs that will be lost out of the SME market across each one of these industries. And again, a lot of it is down to the relevance and cyclical robustness that these businesses potentially hold. We then decided to have a look, well, if this is the industry spectrum that we can see, where is the regional risk coming across? And naturally, you'll expect it to come from your economic hubs being Gauteng, Western Cape, and KZN. And again, Gauteng is the highest employer by region. And given our distributions of risk by region as well as industry that we can see, the risk metrics that are coming across is primarily within the Gauteng zone. And I'll touch briefly on where those risk industries or sub-industries are actually emanating out of. The total graph on the right-hand side is essentially the same. But what you're looking at is potentially 700,000 jobs within Gauteng region alone, and an additional 300,000 out of the Western Cape, and 400,000 potentially coming out of KZN if we reach those worst-case scenarios. Now, understanding that this is within the SME sector, the robustness and the capital clout that larger entities may have had to kind of weather the storm that the lockdown trade restrictions and movement restrictions have primarily brought across, do not necessarily reside with these. And one of the easiest ways of cost optimization or efficiencies within these businesses is people costs. And a lot of that mitigation has come through. If these businesses do survive, they still will survive survive with the low employment count, and it won't necessarily be to the point of retaining the 2.7 million jobs that's residing within Gauteng, within the SME business structures that we have. So of concern, naturally, we can see that in correlation with the business risk or the risk of failure that's coming across from the various industries, as well as the employment counts that currently reside within those high employable industries, as well as these regions, there's a concern of what knock-on effects that may have onto the consumers. And understanding that we see both spectrums of both business and consumer behavior within the South African landscape from a spend propensity perspective, this loss of employment will then naturally have a knock-on effect into large corporates when it comes into your larger retail groups, when it comes in regards to spending power and the ability for consumers to actually drive consumer consumption, which is that major element of GDP that South Africa does rely on. So getting to the point of where does this leave us? This leaves us in a point of understanding where relevance may exist and opportunities for us to kind of resuscitate this market, not get to that 30% mark of default and potentially risk 3 million jobs across the market. The intent is obviously threefold. How do you stimulate job creation? And in order to stimulate job creation, you need trade stimulation to come back, which was very heavily restricted within the various lockdown levels. That being said, South Africa pre-lockdown and kind of pre-pandemic was already within an environment of reduced trade and reduced economic growth. But understanding where these businesses reside and what robustness was actually shown for the survivors. So you've seen the stats where, yes, there is 50% of good business risks residing in the transport sector. Overall, there's still 60% of the business population within the SME market overall that still portrays a lot lower risk of default and failure than their peers within the market. But what type of robustness and what actually met to that? And it kind of comes out to 4 factors that we've identified and wanted to isolate for the broader market for opportunity identification. I think we've fairly seen that the risk increases or the probability of defaults that's coming across in terms of trade lines and credit arrangements and facilities that these SMEs do have a high correlation towards their ability to survive the pandemic and obviously the months preceding now as we moved into lockdown level 1. And part of that is understanding that a lot of those facilities fund their growth, fund their operating capital, fund their working capital, and fund the large majority part of the business that allows them to stimulate and find opportunities for growth out of what wasn't there before. So there's a very clear link between the business risk and business failure, which then has the knock-on effect on jobs that those businesses actually create and currently employ for the broader population in South Africa. One of those points is, given that SME is the easiest point through the lockdown levels and through the last kind of 5 to 6 months to stabilize their business and keep themselves as a going concern, was to find cost optimization routes through either employment or mitigating survival through managing the majority of their costs. We found that the industries that have been surviving have been those that had the ability to move away quite easily in terms of cost management, primarily those that were sitting on a high level of variable costs as opposed to fixed costs. So this may sound like common and conventional wisdom, but it makes it quite relevant in terms of what those industries actually are and what opportunity for growth there are for job creation, trade stimulation in the broader scale of moving the South African market forward. And then finally, through many economic seminars and economic textbooks, a lot of companies and a lot of investors will tell you, look for the cyclical business, stay away from them in a downturn and look for them and try to find that recovery path. I think of greater concern coming down now is that we are moving into what is considered a new normal of trading, of engaging with consumers in market, even engaging with the B2B environment. Traditionally, these types of engagements would be held in a large auditorium with a lot of people sitting around. This type of engagement is finding us a relevant point in terms of how do we change and what our scope of opportunity actually resides within the different markets that these survivor type businesses have actually found themselves in. So we had a look at the industries that made up the large proportion of good risk and low risk of failure entities in the market. And without going through each one of them, you can see at the very top of the list is your dentists and specialist dental activities, etc. And these are essentially the proportions of sub-industries that we've shown you previously that have been survivable through the market. These are those that sitting in the Q2 tracking stats and as of current status have the highest level of concentration of low-risk industries per the metrics and models that we monitor. And the evidence that's coming out of this is these are industries, or these are businesses that reside within industries with a high level of cost flexibility. They can maneuver out of variable costs quite easily without impacting their business and move back into trading environments quite considerably quickly as the lockdown levels would have materialized. The concerning part, though, is these are not where the majority of your employment stats or your employment figures or employed population actually resides. These are very low employers, primarily single entity shops run out of small businesses. And given that they had a lot of variable cost robustness moving in into the different environments that the different lockdown levels actually presented to us. Of concern, though, then is the contra, or the corresponding picture to this of where high-risk industries actually emanated. And naturally, again, your high-risk industries that we're seeing, those that carried a high level of fixed cost, or their business model is heavily dependent on driving a material level of fixed costs to actually operate. And again, not being able to taper down or find optimization or management points against the cost that runs against these businesses made it very difficult for these guys. And this is naturally where we saw the high concentration of high risk of failure or default come across within the next 12 months, and primarily the movement that we've seen from the beginning of the year into the Q2 and the August statistics that we've been monitoring for this population. So with these types of businesses, I think the main concern here is that these are the businesses where you've got scale of employment. Construction is a high employable industry. It's one of the higher employed industry segments that we have that's been driving out a lot of the employment growth within the South African market. But these are the businesses within the SME sector that are showing the highest level of risk because of their inability to drive down costs. And it's forming this concern of where does relevance potentially reside in the future for these businesses. Given restriction of trade, given restriction of economic growth, there may not be an avenue for these businesses to actually resuscitate themselves. And it's quite important for us to then try to identify what steps or what form of transformation these businesses need to undergo in order to make sure that they have some form of recovery that may come through. So with that in mind, we went through the processes of trying to understand where the risk sits, both from a business failure and default perspective, but also what impact it may have on job employment and the future and the trajectory path for employment that we may want to carry. So I just want to leave you with Hans for a few closing comments and kind of the recommendations and advice that we'd want to give out to the SME community and any investors looking to kind of resuscitate this market, given the tough year that a lot of these businesses has felt. Hans, over to you.
Great, thank you, Priv. So, yeah, I guess while you can look at these figures and perhaps have a severe sense of pessimism, I think we do need to look at the optimism. So it's not a case of, if you're in construction, quickly go and study to be a dentist. I think that's not the intent here, but I think it's largely around, how do we shift our businesses, and how do we start thinking about them differently to operate within this new paradigm that we find ourselves. So, if you look at overall economic recovery, the red bars that Priv showed, those are the industries that can largely move the needle. And that's both from a job creation perspective, as well as an economic growth perspective, in that there is a certain level of relevance of those businesses, both on the international stage as well as locally, in terms of creating real economic growth. So I think regardless of which business you're in, whether you're in the non-cyclical businesses, the services industries, the bookkeepers, the selling of shoes that we saw at the top end, or you're in those big heavy lifting industries, what I think we can expect is, our GDP figure will be suppressed. We are in a recession, and that growth is not going to come quickly. So we will be operating in a lower revenue environment for quite some time. So when we look at the four elements on the bottom, and we talk about there is only digital, digital has the effect, and a lot of people think of digital as a website or a fancy experience, but digital is also about doing things more efficiently, doing things in a different way. And I think, there's always been a sentiment that Africa and South Africa has not embraced digital. And I think, this is the time and a catalyst where we will have to embrace digital. So we'll have to create efficiencies, we'll have to create automation, we'll have to do those things that bring us into a more relevant environment. Now, if you look at the banking industry for a long time, our big incumbent banks have been on the journey to digital, to automation. We've had challenger banks come in who are born digital, and the gap is actually closing. So in a lot of sectors, there is the opportunity to just take that last step, double down on digital in terms of the back-end environment, as well as how we're engaging in the market, and operate in a very different way. As I said, the revenue it may not come back in a hurry. We may not be at the same revenue figures that we were last year for a few years to come. So how do we operate our businesses, understanding that that's going to be different, that it's going to be different. Secondly, the market has shifted. People, consumers, businesses, they want to engage in a different way. So, when you think about everything has changed, and you think about a good example is big marketing budgets, billboards on the side of the highway, above the line, to a large extent, people aren't the roads. They're not going to see that billboard. So how do we shift our spend? How do we shift our activities? And marketing is but one example of where perhaps the shift is to other mechanisms, to other ways of engaging customers in a way that they want to be engaged in. So when I spoke about banking, and if you look at the European digital banks, to a large extent, they're having a really tough time now because they've been relying on people transacting out in the market with the card. Now people want to transact online. They want to buy things online. And they have a very different expectation of the customer service. I can't come into your store. I don't want to come into your store. Help me where I am, which is online or on the phone, and I want that as a slick experience. The third element is, how do you deal with a customer base that you cannot see? We all on Zoom calls, endless Zoom calls, conference calls, and we've lost that personal touch. So I've always said that, at least my experience is that South Africans operate on a trust-based relationship. We want to see and we want to look people in the eye and do business. And particularly if you're an SMME or you're dealing in this segment, those trust-based in-person relationships aren't there anymore. We're transacting with people that we've not physically met. We probably won't ever physically meet them. And to a large extent, we need to engage with those people in a way that we can trust them. So, there's one of the quotes which says, trust is good, but for all things other than that, there's data and analytics. And it's really about using that data and analytics to understand our customers, understand, how we're doing business with them. From a digital fraud perspective, we're most likely going to see, that particular area has been growing substantially, exponentially over the last couple of years. We can expect that to grow further. In fact, in one of the surveys that we looked at, we saw a marked increase in people being victims of digital fraud. Now, how do you protect yourself on your online channels and engaging with customers in a different way? Now, you also need to recognize in the SMME world that there's significantly more risk. So if we look at those default rates, those represent potential bad debts in your business. How do you make sure that you give that slick, easy, frictionless customer experience in the way that the customer likes, but still be able to trust and interact with them in a way that you're not saddled with the bad debts of default? So it's very important in terms of how you engage with customers. And then finally, the last recommendation is think omni-choice. Think we is better than me. Think of the distribution platforms that you can start offering your services, your products on. You know, if you can't interact with people from your storefront physically, you know, who does have reach in the market? If you don't have the capex to spend on new websites and the marketing and the social media marketing that goes around it, who has those existing platforms? Who can you partner with? And how can you think differently about how you distribute your product in the market? So think omni-choice in terms of how customers will engage with you. So that brings us to the end of our presentation. We hope that this has been useful just in terms of understanding the data. As I said, it could look quite depressing, but I think, you know, from our perspective, you know, we want to look at the opportunities. You know, trade safely in the market, but it's also, I think it's going to be, you know, as regulations end, as the market opens up, there will be opportunities. And I think it's important that whatever those opportunities are, that there are people who are willing to walk into those opportunities, take advantage of them. Our entrepreneurial SME community is still our engine for growth, but absolutely we need the right-minded people who see the opportunities, look at things positively, and capture that market as it presents itself. So with that, if I can hand it over back to Maurice, and thank you very much for your attention.
Thanks so much, Hans. That's absolutely brilliant and insightful. Just prior to the webinar commencing, we had a discussion. We decided that you're a glass half full man. I, too, would like to think that when it comes to employment, we're very, very, very adaptable as human beings. And what I've seen is quite a bit of pivoting using digital technology. So for instance, yoga instructors whose studios were shut down are now have classes, and they're broadcasting to the whole world, and conceivably they may be doing better. Is this something that you guys have factored in? You know, the telepresence jobs. I was on a call to a banker, and the banker is not immigrating, but is getting a job in Canada. Now that's something new. You know, being able to stay, not immigrate, and earn hard cash. Is this something you guys have taken into account? And if so, how would one?
Yeah, so I mean, absolutely, and Priv can talk to the data, but I think, you know, it's a good example what you're mentioning about a person who's had an in-physical business and they've transitioned it to a digital channel. Unfortunately, in that process, you know, you can think about the example you've given. So the yoga instructor is, you know, still working, still offering the service. What about the receptionist? You know, what about the cleaner of the studio? So I think we need to recognize that the shift to digital, you know, frees up, you know, the ability to get out to a bigger market. You get the distribution, the network effect. I'm not a yoga person. If I try to touch my toes, you'll see that. I'm more of a cyclist. I've been engaging in virtual cycling, you know, sort of that kind of thing. But to a large extent, you know, I mean, I'm now cycling with 1,000 people on a Wednesday morning rather than the 10 people I used to be able to. So you get that distribution network effect in digital. But the low-end jobs is what I'd point to. And if we look at the stats that Priv's talking to, those are the people where those flexible costs, I mean, it's a very kind of non-human thing to say, but that's what we're talking about. Those people on the lower end jobs who are not supporting those digital businesses. Now, if we look at the market opportunity, those jobs are probably not going to come back at the same level. These businesses now need to operate in this world of suppressed revenues, of lower incomes. And they will stay in that world of not being able to essentially provide those jobs. So we need the sectors to open up to create those jobs in that space. But for me, it's not a sustainable thing. From a global competitiveness perspective, we still do need to address the skills challenges. How do we make the receptionist into the yoga teacher? How do we make the analyst into the analytics person? You know, that's what we need to start thinking about. So I think there's a short-term opportunity in a lot of those sectors that Priv talked to. But I think the long-term opportunity is the skills one, which we've spoken a lot about. And my hope and my belief is that this thing is the catalyst that's going to help us to do that. All right. So I don't think we're going to keep falling. I think, as you said, we're going to be resilient. And we're going to look at that opportunity on the other side.
Glass half full. We have a question from Adam. Thank you, Hans and Priven, for your detailed analysis. So much easier to understand than the recent reports from Stat SA, where they hide behind the technical view that unemployment actually reduced in Q2. Can you just comment on that? I mean, what are your views on the reports?
Yeah, so just on those unemployment stats that were sent out, I think there's been a lot of media coverage around the process that Stats SA goes through. Understanding how Stats SA actually gathers that information is quite important. They roughly survey around about 40,000 individuals every single quarter to get to that QLFS survey that they populate. I think the issue with lockdown levels is that they weren't able to get to the majority of the survey. They reverted to quite a few of telephonic type surveys and questions, which meant contactability of individuals became an issue. So I would take the recent results of the drop to 23% with a pinch of salt in context of how surveys would have had to be done. I think the more important one would be now that travel and interaction has been open and a lot more people would be engaged with the survey for Q3 would be more important. I think we need to pay focus and attention towards the expanded definition that still rose up to 42%. There is no correlation that's showing the unemployment rate is dropping in line with the survey. The only consensus is the way the survey was done was materially impacted because of lockdown. The concern, though, is the unemployed population as a statistic on its own is consistently increasing. We have not seen a rise in jobs come across. But conversely, within the spend dynamics that we see from the consumer population, that's been suppressed. So it's not that you're seeing an increase in spending power, increase in income, increase in affordability, disposable income across the consumer categories to note or to corroborate any 7% drop in unemployment rate. But also concurrently, the stats that we're seeing on businesses are feeling a lot of stress and pressure. And I think just reading through on one of Adam's questions there, what is the potential knock-on effect on corporate? Well, to get to that, Maurice, it's a case of if the SME sector employs 10 million people and we do reach a state of the 30% default, which is going to then incur potentially 3 million jobs. That 3 million jobs is what drives the larger corporates. If you look at the major banks, the major retailers, your listed entities that have been transacting, and there's been a lot of media coverage through lockdown about certain retailers feeling the pinch and actually moving into points of non-recovery. Those consumers losing their jobs have the spending power to actually drive material trade benefit for the larger corporates. So if your business model has even a small percentage contribution that may come across from consumer spending power, the loss of jobs, the loss of income that reduces the ability to trade into the channels made available by large corporates is the knock-on effect that's potentially worrying because you're potentially losing 30% of your addressable market and spend that you may have.
Great. So I see we are pretty much out of time. Thanks so much to the speakers today. Thanks so much to the audience. We heard today it's all about digital. COBRA have countless digital partners. We have IQ Business, we have Elysium, we have Microsoft. And as I said at the introduction, we are here to help. These partners are here to help wherever they can on a gifted or shared value basis. Please go to our website, www.cobra.org.za. Thanks so much, guys. Really, really, really invaluable to have you over. As I always say, we'll get you back. So thanks so much. Enjoy your weekend. Bye-bye.